Well, good evening, everybody, and welcome to our traditional Stock Pickers breakfast. And we're going to change the name just a little bit and call it our 21st Annual Festival of Stock Selection. It really is taking the place of our former Stock Pickers breakfast, which we have been doing for the past 20 years. This is the 21st anniversary, and Mark and I have been at every one of them. We've enjoyed every one of them, and we know that a lot of you in the audience tonight have been at all or most of those breakfasts over the years. We want to keep this going as long as we have some interest, and we certainly want to apologize for what happened on November 8th when, through no fault of ours, our webinar would not create itself. We just could not get that darn thing started. So without further ado, let's go through this Stock Pickers breakfast. We're going to start by celebrating the winners. It's important that we stop now and then and pay attention to people that have been doing this, in some cases, for 65 years. These are our anniversary clubs in the MidMichigan Chapter, and you can read them for yourself. Maybe your club is having a 5-year anniversary this year. I know that some of the clubs that I'm belonging to, I belong to the MidMichigan Model Investment Club, who is celebrating its 20th anniversary, and I belong to B.I. Baker Model Investment Club that's celebrating its 10th. So I know a lot of you are here. Look at the numbers of years that some of our clubs have existed and been investing. You know, if you start early enough and you invest regularly, you can't help but most of the time be successful. Here's the winners of our 22-23 Stock Pickers Contest. And we'll start with that entry at the bottom of the map down there, because his entry was at the top of the list. Doesn't happen very often for Mark, but he was the top entry this year. And we've always kidded him when he's come in near the bottom, so we have to give him his due when he comes in at the top as well. Mark is one of our directors, lives in Rochester Hills, and he came in first, and you'll see in a couple minutes by how much he beat the market with his particular entry. Our top club this year comes from the western side of the state. It's the Big Rapids Investment Club, oddly enough, in Big Rapids, Michigan. And we'll talk a little bit about their portfolio, and we'll talk about some unique things about that Big Rapids portfolio. Our second place winner, Big Rapids, by the way, won $100, and the Portvalue Model Investment Club out of Traverse City / Elk Rapids won $50 for their second place entry. My club, the B.I. Baker Model Investment Club, came in third. The Cool Kids out of Traverse City that have finished in the top 5 a number of times in the last 5 or 6 years came in fourth this year. And Synergy Investment Club, that has been in our contest for, I think, for the entire time that we've been doing a contest. They're out of Saginaw, and they came in 5th place this year. We're happy that we had nice representation from throughout mid-Michigan, from the north, from the west, from the central part, and from the east. So let's keep that up, and we'll see what's going to happen. Here's the list of the complete list. I don't want to go down much further than the top 5, but you can find your club if you're here looking for your club and see how you finished. I think it's particularly telling that we had 12 of our entries beat the original $100,000 that went into, I said 100,000, have they beat the original, yes, it was $100,000 that went into this thing. And we had 9 of our entries actually match or beat the benchmark. And we're using the S&P 500 index fund as the benchmark. Mark's Manifest portfolio was 41% growth over the year and beat the benchmark by almost 31 points. Our winning club beat the benchmark by almost 30 points, and our second place club beat the benchmark by almost 25 points. Notice nestled in there at the top, there's another portfolio called Your Choice, and we're going to talk about it for just a moment as well. Here's Mark's portfolio, and Mark had a very typical 5-stock portfolio, and you only need one winner in a 5-stock portfolio if it's as big as Ardelyx. Ardelyx is a bioengineering / drug portfolio kind of company. They've had some problems off and on with the Food and Drug Administration, but they've recently had their newest drug approved by the FDA, and now we're looking to see something really happen with this company. But you can see that from the start of the contest till the end of the contest, it made over 161% in a year. We also had only one loser in the 5-stock portfolio. Usually in a 5-stock portfolio, you need 5 green to win. But with that big performer in Ardelyx, Mark was able to come through as the winner, even though Generac lost about 30%. Here's the first place portfolio. And what was unique about the Big Rapids portfolio, first of all, is even though we allow 15 stocks in your portfolio choices, we have never had a winning portfolio that has chosen 15 choices. This is the first 15 choice winner that we've had in the history of the contest. And this, you're seeing only the top half of their portfolio. And I'm just pointing out that in their 15 choices, they chose 5 of the so-called Magnificent 7 stocks. I put little stars next to the ones that are in the Magnificent 7. You see Apple and Amazon and Google, and here's their portfolio continued with Meta and NVIDIA. Rounding out the 5 choices they make. You'll see that they also had 10 other stocks, and because they have some of these really, really wonderful stocks that were making upwards of 200%, they have a number of losers in the portfolio and were able to go right past those losses with no problems and still come out in first place. Congratulations to the Big Rapids Investment Club. We're happy to have you with us in the newly expanded MidMichigan chapter. And I would love to come and visit your club either virtually or in person. All you need to do is drop me a line and somebody will be there. Maybe not me, but somebody from the chapter will be there, or we'll set up a GoToMeeting and do it virtually. Here's that Your Portfolio, the most popular choices from the contest. And it's just interesting that our people have discovered, just like the rest of the investment public, they've discovered the Magnificent 7. The Your Choice portfolio contained 6 of the 7 magnificent stocks. The only one that's missing from Your Choice is Meta. That's the old Facebook. But you can see that not all the Magnificent 7 for the contest year, which runs November 1st to November 1st, not all of them did spectacularly as you might have expected. NVIDIA really was the one carrying this portfolio, and some of the other really great performers in this portfolio are not Magnificent 7 stocks. I went to the Motley Fool and got this information about the Magnificent 7. Did you know that in the first half of 2023, the S&P was up 16%, and almost 3/4 of those gains were due to the Magnificent 7. There they are listed in the second bullet point, and it's amazing to me that Wall Street right now has a buy signal. on every one of these 7 stocks. I wonder if you were to do an SSG on all 7 of these, if you would agree with that signal. What do you think, Mark?
I think we're going to look at that tomorrow. Years ago, some of you in the audience that have been around for a while will remember that I wrote a piece on Cisco Systems, CSCO, backing around the turn of the century when it was the most heavily recommended stock on Wall Street. It also happened to be at its all-time high. I think it took about 20 years to get back to that price. So I
A cautionary tale, right, Mark?
we are going to take a look at these 7 tomorrow.
Great. The Vanguard ETF, the Vanguard S&P 500 ETF, and the Vanguard Mega Cap Growth ETF provide heavy exposure. If these are the stocks you want to invest in, here's 2 ETFs where you can get a lot of the exposure from these 7 without having to buy all 7 of them and without having to choose between them, if that's where you think the market is headed for the next 2 or 3 years. I'd like to point out in that Your Choice portfolio 2 other stocks, however, that did amazingly well and don't get nearly the press that the Magnificent 7 did. I drew an arrow next to AMD, that's Advanced Micro Devices, and notice that from November 1, 2022 to November 1, 2023, it was up almost 53%. That's quite a move upward for a stock that doesn't get labeled magnificent. I also am drawing your attention to one of our selections in the best small companies list, and we're going to talk about it a little bit more tonight. But in our best small companies last year, and we've relisted it again this year, is a company called Micro Power. And a lot of you chose it in your portfolios that we had in last year's contest, and it did not disappoint, moving up about 26.5 points in that 1-year time frame. Doesn't have to be one of the 7 to really have nice performance. Here is that list, and this is our brand new list that's out. When we put the list out, we told you what we had anticipated the sales growth forecast was going to be, and as a group, the sales growth forecast for this list was about 19%. It had a par value, a potential annualized return. I'll give you that first word again, potential annualized return of just under 20%. And you see the quality rating, and except for one notable exception, and we'll tell you how that one got on the list, the quality is at 65 or better, in the upper third of the quality universe. At one of our bull sessions, we left the very last choice in the portfolio up to our audience. We said, would you like us to put in a second bank, or would you like us to include Ardelyx? And the audience voted to include Ardelyx in the portfolio. So it's there as kind of an audience choice, and we'll see if the audience makes morons out of Mark and myself by the time the year's over, or whether or not we were right in thinking that Ardelyx maybe doesn't have the same quality characteristics as the rest of the group. We're going to be following this list all year long. Our track record in these best small companies is really pretty good, but we did not do very well last year. The Russell 5000 has really not been performing. In fact, it's been moving in the opposite direction of the other indexes. We hope that's something that's going to rectify itself as we move into 2024. But there are many reasons why the pundits right now are indicating that small stocks might be lagging just a little bit. I think one of the reasons is that they define small stocks differently than we do. We ask for our small stocks to do the same kind of work as our large stocks. In other words, we look for history, we look for consistency, and we look for profitability. They have to earn something in order for us to be interested in them for the most part. This list is made up mostly of stocks that have earnings history attached to them. The pundits in today's markets look an awful lot at stocks that have price to hope ratios rather than price to earnings ratios. Here's the best performing stocks in last year's contest. And I've already shown all three of them to you, but one of them I've kind of hidden, and we'll talk about that in just a moment. Meta Platforms at 219.38%, NVIDIA at 195%, and Ardelyx at 162%. What do you think the fourth one is? Any guesses? That's not a question for you to put in the questions and get Mark all balled up trying to answer it and everything, but here it comes, all right? The fourth best performer was MI Homes, ticker MHO. 93% return from November 1st, 2022 to November 1st, 2023. How many of you actually owned this home builder or another home builder and panicked and got out of the whole industry way before it became profitable again in the contest year? Here's a price chart, a 1-year price chart of MI Homes going from November 1st to Halloween. And you can look at it, you can say to yourself, well, there was even a time when it was doing better than where it ended the 1-year period, but there was a lot of time when you had to have patience and some discipline when looking at an SSG that, frankly, folks, except for the pandemic year, was never really broken. You had to ask yourself, were the problems that the home builders having, were they temporary or were they going to be terminal? And folks, I think that with demographics the way they are, with housing supply and demand the way it is, I think most of the home builders that have a large enough geographic base have temporary problems, not terminal problems. I just don't see interest rates staying at the relatively modest place of 6 or 7 or 8% compared to the interest rates that so many of you went through in the 70s and 80s when you bought your first home. I can remember buying my second home and paying 18.5% interest. I think they're going to move down from where they are now, and where they are now is only 6, 7, 8%. Mark, any thoughts about the home builder making it to the fourth best performer in the contest?
Yeah, I think it is a challenge to continue to stay focused long term when you're getting inundated. And this chart actually shows another look at the longer term perspective. Yeah, and it's always been a challenge. MHO was actually in our 10 cup portfolio and was taken out at some point along the way. So we actually lost a little bit of patience. Big term picture, it's a tough one. Matt Spielman out of our Houston chapter does a lot of work with putting the whole thing in perspective. You do have to consider the demand. There's a whole bunch of stuff out there, or at least a slice of stuff talking about when the boomers begin to sell. What's that do to the supply? So, there's a number of ways that need to really be carefully considered. Big picture, you find a decent home builder like this one, or Green Brick, or one of the other companies, it can be an interesting long-term hold, but sometimes you got to grit your teeth a little bit and go a little bit white-knuckled.
I think what's so fascinating, Mark, is that this 3-year chart shows that no matter when you might have invested in the last 3 years, you're probably making money unless it was just in the last 2 or 3 months that you bought this home builder.
Right.
If you invested 2 or 3 years ago and held on and believed in the demographic story that's beginning to play out with no housing supply, then you would have been making a profit in this company, and it would have been a fairly decent profit for a lot of the time that you could have invested in it. Let's look at some housekeeping, and then let's move into the class we promised. We do have certificates for all of our anniversary clubs. We have certificates for the top 5 finishers if you collect that kind of thing and put them on your wall of the place where you meet. And we have cash prizes to mail out to Big Rapids and to the Port Value Model Club. All I'd like for you to do, if you'd like your certificate or if you'd like your check, is drop me an email. There's my email address. Let me know your name, your phone number, and your address, and we'll mail the certificate and the check directly to you as soon as possible. I might give you a call if I don't know you personally and just kind of double check that I'm not mailing a check to somebody that's trying to scam us out of a huge amount of money. Remember, the cash prizes are $100 and $50, okay?
Now,
Our next
Ken,
contest, go on, Mark.
sorry for interrupting, but will you be delivering my trophy, or do I need to pick it up at your house, or?
It's a virtual trophy, Mark. So just enjoy the kind words. All right.
Okay.
All right. Our next contest will begin on April 1st, 2024. We feel we're going to have a little bit better luck if our contest ends on March 31st in 2025, and that's when it will end. And then that'll allow us to do some programming in April when the weather's just a little bit better and we're not butting up against deer hunting season. We'll have entry forms and a copy of the rules on our website, and we're also going to be mailing that kind of stuff to past participants, and we'll be putting it in a newsletter that should be going out sometime in early January. If you'd like a copy of the celebration slides and the slides for the class which is following, either drop me a request at the same email and I'll make sure a copy goes to your inbox, or drop Mark a request at markr@manifestinvesting.com and he'll see that you get a copy as well. One of the two of us will get it out to you in PDF form, and you'll be able to show it to other people and to review it if you find that's necessary. So let's move to our 20th annual Festival of Stock Selection class. This is not November 8th. This is a couple of days later. And we're sponsoring this by Better Investing and by Manifest Investing. They have been kind to us and co-sponsored many of our events. Many of the things we do, Mark and I could not do without the direct help of me helping him and him helping me. It's just, we're better together, folks. We're better together. This is an educational demonstration. We think investors should conduct their own review and their own analysis of any company of interest before making any investment decisions. In other words, we're not the boss of you. You make the final decision about what you're going to invest in. If you would like an email reminder about the dates of upcoming roundtables, drop an email to nkavula1@comcast.net. That's my wife, Natalie, and she'll help you get enrolled on our guest list, where we'll send you a once-a-month reminder along with a link to register for the round tables. And again, there's those email addresses if you'd like copies of our slides. If you'd like to sign up for these things that I've been talking about called bull sessions, then here's a URL that anybody can use, and that will sign you up. And for a bull session, you only have to sign up once, and then you'll have a link that can be used every time you want to come to the bull session. Have I covered it all, Mark, or did I forget anything?
Yeah, when you go to that link, you are offered the opportunity to cherry pick the sessions you want to join, so you do have control over that.
Okay, great. Folks, we're going to start this by asking you not to stop investing. You hear us all the time talk about the stock market returning 10%, and sometimes we get challenged on that number. Well, here's the data to back that up. From 1950, and actually it goes back before that, it's just that the S&P 500 hasn't been around that long, but stock indexes have been around longer than that, and we can measure their growth. And Mark and I always hedge our bets a little bit by saying 9.5 to 10.5% growth over long periods in history, depending on what index you're using to make the measurement. Here's the S&P from 1950. That's a 73-year history. You can see the blips along the way, but you know, things that seem really, really important when they're happening look like just blips on a generally upward moving chart when you put it in long-term perspective. You can see JFK being killed. That's the seminal moment for most baby boomers. You can see Y2K. You can see the housing crisis in the Great Recession of 2008. And you can see lots of other things as they were happening. But when you look at the graph as a whole, you notice that it's generally up and it's generally moving at a slope equal to about 10% a year. Nicholson's gift to us was to remind us to invest regularly, to buy high quality growth stocks, and to be prudent. And for him, that meant to shop patiently and diligently and to diversify. He added to diversify not only by sector and industry, but to diversify by size. Nicholson called the investment club movement his grand experiment, and we're still at it today. Many of us in very, very superb clubs that are really outperforming the market on a regular basis, and many of them still following the principles laid down in the early 40s by this very bright and forward-seeking investment counselor. We owe a lot to George Nicholson, and we're following through on trying to fulfill his mission, was to teach the values of long-term investing. Mark, why don't you cover this slide and tell us what it's talking about?
Yeah, we kind of want to put things in context. Again, going back to the previous slide, it's been a while since I was responsible for the portfolio contest at Better Investing, but the one major takeaway that I would offer to the audience was this notion of this fairly broad spectrum of performance. I got to tell you, the worst performing clubs were checking in at like 8% a year on their annualized returns, and they spanned all the way up into the 20s. And I was a member of the Mutual Club of Detroit that checked in at 13% for multiple decades. And, you know, we get the question, you know, why are we doing this? And what you're looking at on the screen right here is basically just capturing. Now, that's not the Magnificent Seven that Ken was talking about a few minutes ago, although many of them are in that Magnificent Seven. These are the 7 most widely followed companies by investors at Manifest Investing. And they're also going to line up pretty well with the Better Investing Top 100, the Bivio 100. These are just very widely followed, widely held companies. And their returns are shown there. Those are annualized returns for multiple decades. You see that middle column? That's the actual annualized return. And then compared to the benchmark. Again, the benchmark runs around 10%. The column on the far right is the answer to the question, how much are you beating the market by? So we want to compare that versus the major indices just to convince ourselves, why are we doing this? So go ahead and give us another flick, Ken. You can see the NASDAQ and the S&P 500 and the Wilshire 5000. Over the long term, those are basically all pretty much the same. Call them 10%. So again, we're out there trying to beat that. Over the last several months, maybe 18 months, could even be going on 2 years, the mid cap and small cap classifications for stocks have suffered, and they've actually fallen behind. Normally, they would lead this group of five, and so they've dropped down. We think there's opportunity there. We hope our best small companies for the next year will benefit from the fact that they've been down so hard. Go ahead and give me another click, Ken. Here's just the long-term evidence over the very long term that shows even up at the top. At the top, you see the blue line is the S&P 500. That's the large companies. The red in the middle there are the smaller companies, Russell 2000 type companies. In the orange, and this kind of stunned me, those are our medium-sized workhorses. And again, historically, the small and medium companies are very important. That's why we want 25% of our portfolios in small companies, faster growing companies, and as much as 50% of our portfolio in these workhorses. So good stuff. So just taking that and putting it in further context, one of the things we talk about a lot is all of the above investing. We consider the value line arithmetic average to be that, because it has small, medium, and large companies in it. And you can see that doing that all by itself gives you a bump in performance. So that's kind of a cool thing to know. Just as an example of how this stuff can work, our 10-cup demonstration portfolio is simply buying better companies at better prices since 1994. In a 401k demonstration portfolio, that's some pretty powerful stuff. Our best small companies, even with a couple rough years, is leading fairly well. And then finally, Ken, our last demonstrations, again, our 40 most widely followed companies doing pretty well. And then that roundtable you've heard Ken mention several times. Once a month we get together with a couple of 3 or 4 of our close friends who are members and advocates of the Modern Investment Club movement. And I'll be darned if we haven't climbed back above that 5% target level, demonstrating that returns of 15, 16% per year over the long term are feasible. So it's just a wonderful demonstration.
I think it's nice to ask a question of members every now and then, Mark. If I were to offer you in 2010 an investment that would make 14.5% year over year over year for the next 13 years, would you take it? And that's exactly what the Roundtable portfolio has done. It's performed at 14.5% over 13 years. And right next to it, we see what the Wilshire 5000 has done during that same shorter time period. Here's what the Wilshire did since 94. Here's what it's done since 2010 right here. Let's move on. Here's a chart of the Roundtable. It also tells you on the left-hand side what the goals of the Roundtable have been since we conceived this experiment back in 2010. And the dotted line on the chart basically is suggesting beating the market by 5 points. That's where that 15% goal comes from, folks. That goal that you hear so much about in Better Investing. Nicholson didn't have the tools to give us all this data on an immediate basis. He started this stuff in the 40s. So he knew that the markets had done 10%, and he said, I think our clubs can beat the market by 5 if they're really high performing and if they stick to the rules. Don't get upset if you're only beating the market by 1 or 2. That is still significant when you compare it to the performance of many, many, many of the mutual funds and ETFs that exist in the market today. Finding indexes, finding mutual funds, finding ETFs that beat the market by more than a point or 2 on a consistent long-term basis is a very difficult thing to do. And if your club can beat by only a point or 2, it's still doing better than, I would hazard a guess and say, 85 or 90% of all the mutual funds and ETFs that exist. Mark, anything to add to our performance here, or you just want to say wow?
Yeah, well, the wow is because this level of performance would actually rank in the top 1 or 2% of all available public investable options. So that's why it's there. it's also in combination with that previous slide, the answer to the question, why do we do this? And there are no guarantees in the world of investing. You know that you could end up down there in that 0 to -2 area, but just keep pressing on, because we basically have demonstrated that it is possible. No guarantees, but it is possible to achieve this type of performance.
Mark, I'll give you this slide because you know it's my favorite and you the one created it, so you go and talk about it.
Yeah, this one's pretty cool. It's actually one of our core belief slides. And we, like Ken said, we've been doing this since 2010. We've made 775 selections or decisions. Every time we do that, whether it's a knight or a guest damsel or the audience vote at the end of the session, again, these are monthly sessions. We put $1,000 into the whatever investment we're talking about. And again, at the date that I made this slide, the rate of return for those 775 selections, we do some selling, there's some portfolio management, but the rate of return since inception is 14.8%. One day we decided, well, why don't we take a closer look at how this stuff is doing? And I was a little bit stunned to find that basically a third, or 278, 36% of the choices we had made were actually at a value less than that original $1,000. Now, keep in mind, there's a bunch of them. They're like at 980, 990, 960, like that. But there are a number of positions that have generated losses. We added up all 278. Now, keep in mind, this is those that have been closed out, so they're realized losses in addition to the unrealized losses, but that number adds up to 72,748 for the losses from those original $1,000 investments. Well, Microsoft is a 5-time selection, so $5,000 invested in Microsoft is now worth $78,967. That means that the gains, the unrealized gains from Microsoft, because this is an open position, stand at almost $74,000. So this one position in the portfolio, which is the largest by percent of assets, completely offsets all 278. Now, I don't know about you guys, but every time I do this, I actually get chills thinking about this, because it prompts the next question, which is, what would we ever be afraid of? Following the modern investment club approach to investing, why would you ever be afraid? And that's what this slide says to me. And I think it's an incredibly powerful thought when you think about it, because there's a number of positions and that performance is pretty powerful. So what are we afraid of?
We'd love for you to join our YouTube channel. I've said it once already during the program, and here's what the homepage for the Manifest Investing Roundtable YouTube channel looks like. If you hit subscribe, you help us out a little bit. We're over 1,000 subscribers recently within the last 3 or 4 months, and we'd like to continue. And you can find any program that we've done in the past 12 or 13 years sitting on this YouTube site right now. It's a great place to go when you can't attend what we're doing live. It's a great place to go to review something that that was talked about, but you've forgotten some of the details. It's just a wonderful resource, and we urge you, if you haven't already given it a try, to see what's going on. Here's the status of the best small companies, and there's that same list that I gave you earlier. One of our small companies is really off to the races already. All of these positions started at $50,000. So you can see NAPCO Security up there now at $71,000. It certainly has gained an awful lot in a very short amount of time. These prices were at the close of the market today. That's only 9 trading days since we presented the list on November 1st. And you can see that we're already about 58,000 ahead of the $1 million that we put into the 20 stocks to start with. You can get this particular dashboard at Manifest Investing by looking over on the right-hand column. You'll see a number of different dashboards listed as public, and then down at the very bottom of the list, you'll see more. And if you hit more, you get a big long list. and you're looking for best small companies 2024. Best small companies 2024. If you'd like to just get the names or follow what the stocks are doing. George Nicholson talked about a triple play, and many of you have heard of a triple play before, and we're just going to go through it real quickly because it pertains to some of the things we're going to do just a little bit later. A triple play happens when three things become true, and I'm going to show you these three things on three different slides. The first thing is that the stock you're looking at needs to have a depressed stock price. Well, if I'm thinking, what would a depressed stock price look like just about now? I could kind of turn that around and say, well, you know, if the average returns for the stock that are anticipated are significantly higher than the returns for the entire market, then that might indicate that right now the stock price is depressed. On October 27th, Value Line suggested that the potential for the next 3 to 5 years was about 75% for the stock market. If you annualize that at 4 years, that works out to 15% a year for 4 years, or just under 12% a year for 5. The MyPar number, which is another average number, was suggesting 13% for the next 5 years, pretty close to what the Value Line number was suggesting. So I think a depressed stock price might be a stock that has potential in the upper teens or higher. Number 2, increased profit margins. We basically want to look for stocks that have forecast net margins bigger than the current net margins. And you know, we get such a forecast right on the Value Line sheet. Number 3, the PE ratio should have the possibility of expanding in the next 5 years. So we'll be looking for stocks where the current PE ratio is less than the projected PE ratio 3 to 5 years from now. Here's an example of what I'm talking about. I think those percentages signify that Middleby Corporation's price is a little bit lower because the potential is much higher than the average. I'm looking down here and I notice that the current net profit margins for Middleby are 12.2%, but the anticipated net margins are at 14%. In other words, an increase. And then I look up here and I get a PE ratio at the moment. It's kind of an oddly figured PE ratio, but it's good enough for this calculation of about 13. And the projected PE ratio is 19. I think Middleby Corporation is a triple play. That does not mean it'll be in the buy zone on an SSG. What it does mean is that if you're looking for ideas to study, Middleby should probably be on that list, and you might move it to the top of the list because it's a triple play. One more example and then we'll continue. Look at the price appreciation for Tapestry. This is the old Coach. I certainly think that's on the high side compared to the average around 12, and that signifies to me a depressed stock price. Here's the current margin at 14, 14.1, 13.8 for next year, and here's the anticipated margin going out 3 to 5 years. Not a huge increase, but an increase nonetheless. And here's the PE ratio today compared to the projection. Another triple play. Again, not necessarily a stock that's going to be a buy on a stock selection guide, but As far as ideas are concerned, you might move tapestry to the top of any list that you're coming up with. Why? Because it's a triple play. And Nicholson said, when you find stocks with these three characteristics, you have a better than normal chance of finding a real winner. So let's do some screening. I'm going to start with the online tools that many of you already have access to, and I'm going to suggest that you can get to the screener by pressing the spyglass on the front page where the online tools box is. Press that spyglass, and part of what comes up are these predefined screens. I want to focus on the fact that there's a new predefined screen in here, right here, called A-list stocks. There's a quality screen in here that didn't used to be there before. And there's the small company screen that's always been there. This A-list is a new screening set of criteria. If you press the question mark next to the A-list, you find that the criteria are listed right below. I won't read them to you, but it's such an easy screen to run. One button that I urge you to run it every now and then, and I especially urge you to run the small company screen every month or so, looking for brand new companies, brand new small companies. Here's what I get when I press that small company screen, and this was pressed maybe a week ago when I captured the slide. Notice, out of the entire Better Investing database of over 5,000 stocks, only 11 of them make the cut on the small company screen. You can read the ideas as easily as I can. If that list were larger, you could filter this by sector by typing in a sector and bringing those to the top of the list. Or you could further filter it by industry by typing in an industry, and then it would move to the top of the list as well. There are many other things you can use to filter. Notice there are scroll bars along the bottom, which means you can move over to the right quite a bit. And there's a scroll bar at the top here, which means there are some companies that are cut off of this list. We're looking at 11, and this is only showing us 9. Make sure that you see all the companies, and if you want to try to go through these quickly, I would suggest you start by pressing this button on the first company. Here's what comes up. It doesn't take a genius to say, I like the graph or I don't like the graph. Remember, you're only filtering to develop a list when you're screening. And I think this one definitely would go onto a piece of paper, or however you do your low-tech collection of data, as a possible idea. Once you've said yes to that, would that take 2 seconds? Then press this button. That's the next button, and you'll go from Axos to Clearfield, where you'll again be able to say yes or no. And then you can go through all 11 companies on the list, and you can maybe narrow them to 5 or 6 of the most well-behaved companies on the list. Again, I do this screen at least once a month, looking for companies that I'm not familiar with. Those are usually new to the database, and I want to explore those new companies. Here's when I run that A1 screen. Notice there were 32 companies on the A1 screen down here in the corner. And again, if you press this button, you'll get the first one for Addis Home Care. You can look at the graph real quickly and you can decide yes or no, and then press the next and go through the list. You might want to filter the list so that smalls rise to the top. Or if you're looking for a medium-sized company, type an M in this filter and the mediums will rise to the top. Again, there are bars to go to the right and to go down. Make sure you catch all the companies. Make sure you notice all of the numbers that exist. Wonderful predefined screens, one button. That's all you got to do. Now we're going to move on to some favorite screens from Manifest, and I'll let Mark make the introduction to this because Manifest is his baby. Go on, Mark.
Yeah, and you took away my Mary Poppins.
I did.
Julie Andrews. And really, screens like that, I'm surprised you didn't put one of our overhead screens from 20 years ago.
I could have, you know.
All right. Well, as we were preparing some thoughts for our New Orleans audience last weekend, sat down and gave some thought to the various types of things you can screen at. It probably is, and deservedly so. It's one of our subscribers' favorite features. And you can screen on many of the things we've been talking about here, including identifying triple play candidates, as you can see on the upper left. But I think one of the neat things we really do is we actually give you the opportunity to search for what you need. We believe that the two most important things are the return forecast from the companies that we study, the projected annual return on the left there, and the quality of the company. And you can basically search for any of those things. You can search for smaller companies with the growth forecast. You can search for companies trading near their 52-week lows. We're going to talk about some of these in a little bit more detail. This relative strength index, if you're not familiar with it and you're in an investment club, I think the mission of an investment club is to be open-minded about anything like a relative strength index on a technical analysis chart. Learn what it means, learn how to interpret it, and then you can decide whether or not it's meaningful or useful for you. And then we're going to also spend some time talking about the core score, which we thought we had some fun with that down in New Orleans. Go ahead, Ken. So here's just a look at the screener. You basically can pick and choose what you want and just basically search for what you need. Okay, go ahead, Ken.
I think the most simple screen that you can do in Manifest is just press these two buttons and change them from no to yes. Make the two buttons read yes, and I think this is what you get right here then, don't you, Mark?
Yeah, and the definition of a sweet spot, we don't necessarily think in terms of buy zones, but we do think in terms of attractive return forecasts. And the projected annual return for this set of companies from that particular screen would be companies that are probably going to complete the triple play, and they're going to be companies that have a 5 to 10% advantage to the general stock market, as Ken is showing you there. So that's a pretty good list of companies to take a look at. I will say that at least 4 or 5 of those made our finalist list for the best small companies for this year. So it's a pretty reliable screen. Again, you're looking at companies with attractive return forecasts, same as section 5 of a stock selection guide, that also have exhibited strong quality characteristics. So good stuff. I think we ended up going with at least 2 or 3 of those for sure. All right, go ahead and show us the next one, Ken. This is my favorite screen. Basically set the Manifest rank, and you want to set it to 99.44 if you want to be really regimented about the Procter & Gamble number, 99.44. You will be looking at the top 0.5% of all companies at Manifest. What is the Manifest rank? It's basically taking the 2 most important characteristics and combining them into an equally weighted index, or whatever you want to call it. It's a characteristic. But what's the top 0.5% of companies at Manifest? This is one of my favorite places to go shopping. Again, you enter one number and you get this list of potential ideas for further study. So some pretty good launch pads right there as you see it. The yellow, by the way, is exactly what some of you are thinking. Too good, could this be too good to be true? Be careful out there. The higher, if that number is in the yellow, it means that the return forecast is kind of off the charts high, kind of like Ken's coach number, above the 22.4. It's way above the average stock in the stock market. So just simply be careful out there. I'm generally going to demand a very high quality level if I tiptoe into that area for an actual investment.
Yeah, and we like to tell people that the closer it is to the top of the sweet spot, the safer you probably are. These are relatively close to that sweet
they're not
spot.
bad.
Yeah, so they're not bad, but when you start seeing these at 29, 30, 31, 32, that's dangerous territory then.
All right, and here's another one. I just want to spend a moment talking about, especially, the last 6 months have been pretty rough, especially the last 2 or 3. And every once in a while, you can isolate opportunities that are outsized opportunities. And we encourage people to become familiar with this relative strength index. The relative strength index, abbreviated RSI, anytime that's below 30, you have potentially an attractive entry point for a stock. It's also the answer to the question when you see the talking heads on CNBC and they say, hey, this stock is oversold, it might be attractive. They are generally talking about this type of an indicator. Anything below 30, and anytime it gets below 20, it really grabs my attention. On the day I ran this screen, which is probably within the last 2 weeks, this company InMode, which is kind of at the center of some of the stuff going on in Israel right now, and it's also at the center of being one of the companies projected to benefit from the obesity pills that are all the rage right now. As people lose weight, they need cosmetic surgery. That's what these guys do. And they're also headquartered in Tel Aviv. So there's some, there's a backstory there. But the point of the story is the stock price got crushed, driving them to the top of this list of potential study candidates. There are a number of very studyable, if that's a word, companies on this list as potential entry points for right now. Okay. Go ahead, Ken. I think, did you leave the slides in here for, okay, here's the, this again, as a member of an investment club, learn about what this stuff really means. Then you can decide whether or not to implement it or use it. That's up to you. This happens to be from stockcharts.com. It's a free site. You don't have to pay for this. And you can actually visit their school to learn more about what the relative strength index is. All it is a fairly short-term indicator. Again, we're just talking about opportunities to buy in or potential opportunities to trim a position if it gets overbought. And that's what they're showing you here with McDonald's. Anytime it gets down below 30, potentially oversold, could be attractive for purchase. Anytime it's above 70, and we actually use 80, it's potentially frothy or overbought, or if it makes sense within your portfolio to perhaps trim or sell a position, that might be the time to think about it. So we use these for screening. We use them for alerts in our work at Manifest Investing. So again, you can go to that page at Stock Charts and learn in a little bit more depth what it's about, but that's all we're doing here. Just simply looking for opportunities to sell or to buy. This actually takes us back to that moment in time just a few years ago when the pandemic hit. In the first few weeks of that, it was rough, absolutely rough. And I'm sitting there one morning looking at relative strength indices for a number of companies. And you can see with that listing on the left of a whole bunch of community favorites. I had been shopping for a company for my son-in-law who's culinary like Ken. And this ticker symbol CHEF came up, and you can see how badly the stock was damaged by what happened with the pandemic onset. And again, as Ken asked earlier, the question, relative strength index is way down, almost at 10. Is this a temporary or a terminal condition? That's the way Cy Lynch always describes it. And I was sitting there thinking, could this be too good to be true? To make a long story short, I had basically finished my analysis, went up, made a hot dog, came back down, and the price had gone from, I believe it was 12 to 30 in a matter of minutes. And it jumped right up. But this entire list was an interesting list to look at the time. And again, just a demonstration of when things are really rough out there, sometimes it does make sense to go shopping. This relative strength index can be a source of study ideas in that situation. Okay, go to the next slide. And this is actually not looking just a few days ahead, but this is a year and a half later. How did these companies that showed up on that previous slide perform? And I think we can agree that there was some worthwhile opportunities on that list. I did happen to buy a couple of these, including Wolverine Worldwide, the hush puppy company out of Rockford, Michigan. I took personal ownership of that, but notice how my Chef's Warehouse did up at the top. I missed out on that one. But some pretty good companies on that list, and again, an available opportunity. They didn't all work out quite so well, but hey, all those total returns are in the 20% plus annualized, so it's pretty hard to complain about any of those. So again, the moral of the story is you can use the relative strength index as a source of ideas, and you can screen on it at Manifest. All right, we had a little bit of fun with the New Orleans audience here. That happens to be Ken caught that image as I was coming off the tennis court a couple years ago, Burt Lake in Michigan, and I have to say I haven't maintained that level of physical fitness. Maybe I need to go back, Ken, but appreciate you capturing that moment. No, just kidding. That is simply a tribute to core and keeping a strong core. And what we're talking about here is something we sat down one day and we're like, what is a core company? What does it really come down to? And, the answers are going to vary, but they're going to all kind of circle around this notion of, well, the company has to be financially strong. It has to have a high financial strength rating. And then everybody here that's here tonight knows that we like up, straight, and parallel. We like our lines to be straight on our stock selection guides with allowances for economic pressures and all that kind of stuff. But earnings per share stability is important to us. And then last but not least, and it includes those first two characteristics along with a few other things, the quality of the company should be high. What we discovered is the companies that we would generally sit and regard intuitively or instinctively as a core company, they would score pretty high in those three characteristics. So we said, well, let's add the three together and see what we come up with. And what we came up with was anytime that those three numbers add up to, and this is a squishy number, plus or minus, but anytime you add those three numbers up and you get 225 or higher, you're going to generally be thinking of that company more as a core type company. So this screen, using the Manifest screener, simply, I want to find the ones at the top of the list. I chose a core score of 288 just to see how many companies are above that. And as you range down that list, I think you will generally agree with a couple of curious exceptions, but not very many. This is a pretty good list of companies which you would have respect for. Visa, Alphabet, and Apple, rank right up there near the top of the companies in that Magnificent Seven. So they're right there along with them, but along with a few other, maybe a little bit more off the radar, a little more obscure companies, but some that are fantastic. I mean, the average investor on the street, not true for our community because you guys are not average investors, but Expeditors, very few people have heard of it, fantastic company. And there's a number of companies that come to mind that fit that mode. So this is a list of companies that we find fairly compelling. Again, this is sorted by those core scores, but again, I would look at this type of a list and maybe even settle for a little bit less return forecast for a company like this. Over the years, we've talked about how Johnson & Johnson rarely goes off the charts on sale. It tends to trade in a fairly narrow return forecast range. So again, anytime it edges up to the top of that range, it can be very attractive. That's true for these also. So Ken, anything you want to add to that?
Yeah, I think it bears repeating, Mark, that when you screen folks, you're screening for ideas. You're not necessarily on the first go around screening for buys. we would expect that you would do further analysis on any company that comes up on a screen. There's some great ideas on here, but just looking at the par values, I think probably only half the list or less would show buy on a reasonable SSG. So you're screening for ideas, and then you're going through those ideas on a stock selection guide or some other tool so that you can decide which of those companies you want to buy and which might be something you want to sell, or in the third possibility, even hold on to. Patience and discipline. That's what investing should be all about. It's so important, especially in a club, and especially when times are a little bit challenging, for you to keep the club patient and to try to maintain as much as possible the discipline that you know will eventually give you profits. Your club should never, ever again be able to say, I'm out of ideas. We gave you enough screening ideas in this particular presentation to last anybody for the next 20 years. Remember that most of these screens can be generated in less than 20 or 30 seconds. So there's no need to generate a screen and then hold on to it for the next 6 months. Generate a screen, come up with some ideas. If none of those work out, generate a screen again and start with some other ideas from whatever's happening. The market moves, and because the markets move, screens change even if the criteria stays the same. Again, patience and discipline. Folks, we're better together. We're better in a group. We're better as partners. Trust your partners in your club. Ask them for their opinions, and then listen to what they have to say. Happy Thanksgiving, everybody. Turkey Day's coming up pretty quickly, and I have a lot of cooking to do. Mark?
Same here. Happy Thanksgiving to you all. We have managed to stay ahead of any questions in the questions box. See if anybody has. I do see one popping up here. Oh, this is just thank yous, Ken. And Matt Spielman said, happy anniversary to his former club, B.I. Baker. He's extending best wishes to B.I. Baker.
Oh, well, Matt, we miss you a lot. You know that. And we'd like to thank all of you for coming to this rescheduled event, and join us on YouTube.
We've got Herb with his hand in the air. I'm going to go and unmute Herb. Herb is our statesman.
Okay. Go on, Herb. You have the last word.
Okay, Mark, I was just going to ask, if you hadn't got rid of Apple in your roundtable stocks, what would that have been in the growth in comparison to Microsoft?
If we hadn't got rid of Apple, I don't know the answer to the question, Herb. I know that we did exit it at a fairly high point. It's a question we can answer. I do not know the answer to it, but I will take a look at it.
Just might want to look at that. Okay. Have a good evening, and thank you.
Thanks, Herb.
Good night, everybody. Thanks so much.